Hey guys, let's continue with the Supreme Court story. Last time we talked about the business continuity. Let's just go back to the KPI. Again, KPI stood for key person's insurance or key person's life insurance would be more accurate. But let's just say KPI has been playing a very important role. It has been more than a century because, let's think about Lincoln Financial. That's one of the prominent KPI players in the field. They've been starting doing business since 1905. So it's more than a century old. Okay, so this one has, anything existing for a long time, there is some reasons behind, right? So KPI is very important, very convenient, very easy. There's no, doesn't involve any other entities, just between your business and the insurance, life insurance carriers. That's it. You don't need to set up any trust and no any other special arrangement, and that's pretty much it. But this time, because the Connelly case ruling in the Supreme Court, that's two things. Remember, I said that one is the valuation. How do you evaluate a private company, private entities, or closely held entities, right? In the Connelly's case, it's just the Michael and the Thomas, the two brothers. They own the whole business, right? So, and then, if you think about this continuity, business continuity, one in three of the business have been only survived for the second generation. And even when it comes to the next generation, from grandfather to grandson, it's only 12% that succeeded. So we do need business continuity, and the life insurance, KPI insurance, serve that purpose very well because it has been around for a very long time, and then but this time, if you check that the business continuity, you will see that the KPI is, for most cases, KPI is not listed. Why? Partly because the Supreme Court ruling this time. But this really doesn't have to be the way. I really think that, you know, uh, um, Supreme Court did two things. Again, one is the valuation, another is taxability, right? So on the valuation part, remember last time we said about on the valuation part, the Supreme Court did a very good job, very well written, very well cited, and very thoughtful. Okay, and it convinces us that just because your life insurance, KPI insurance, death payment, the lump sum payment, that's not just because the company has to use that life lump sum to buy back the shares of the dead brothers, like in this case, Michael Connelly, right? So, by the way, let's uh, buying and redeeming shares is a different thing. Different thing. If you say selling, if you are selling your shares for any public traded stock, that's basically your individual behavior. You go to the market, you sell your shares, and somebody else will buy it, right? Based on different viewpoint, different perspective. Some people will buy it, some people will selling it. So that's a personal behavior that the shares that has been sold will still remain in the market. But when you say redeeming, that's a business behavior. That's a corporation behavior. Redeeming means that the company will buy back the shares from the market, and those shares typically will out of the circulation. They won't be in the market anymore, so not available anymore. So it's basically dead. It's a withdrawal from the market. So, but anyway, so let's look at this. Uh, the, the KPI says that if somebody died or somebody become disabled, either way, that the KPI will pay you a lump sum, and that money technically you can use it for different purpose, but in this case, in the Michael Connelly case, the terms specifically said that the money will be used to buy whoever died first. But in this Michael Connelly's case, he owns like 73% of the market share of the company's share, and then his younger brother, Thomas, is only 23%. So he's the majority shareholders. But so this way, because they specifically says that the money cannot be used for any other purpose other than buying back whoever died. Okay, so the Thomas Connelly's legal team, argued that this is not part of the fair market value because they call that a liability. The company has to buy back the share from Michael's hand. Okay, so because of that, and it's not a fair market value. That means that it's not subject to tax. It's not taxable, basically. But basically, the Supreme Court basically shoot it down and says, no, that's not the case. Even though you have the liability of the selling the share, that doesn't mean that the fair market value should exclude that. Okay. Again, the same thing. I mean, there is one example. Let's say your company owns some, has a lot of asset, but also liabilities. So one of the assets is that your company holds some like 100 ticket for going to Disneyland, because that's a part of the money that to give the employee incentive for visiting Disneyland, right? That part of money, it's not the ticket. As long as the ticket is not used, that will be counted as the part of the company's asset. Okay, so just because it has a special use, it doesn't mean it's not a part of asset. It's still, a part of the asset. So basically, Supreme Court is basically says that, yeah, you should really count it as a fair market value. Again, the other example we can say that on the open market, for two strangers trading on the company, one stranger, one interested in buying the company, Connelly's brothers company, and then the life insurance death payment counted as a part of an asset, of course, it will be counted, right? So that's the idea. The whole argument goes on this. So the reason, the part that I'm trying to say is that, although the valuation part is good, you should be counted. That money should be counted. But that doesn't mean that, like I said the last time, not every dollar in the fair market value is taxable. Okay,